Hello everyone, welcome back. Today we are going to discuss about a very fundamental concept in the stock market known as PE, which is price to earnings. Whether you are a beginner or looking to brush up your knowledge, this video will help you to understand what PE ratio is and why it is important and how you can use it to make smarter investment decisions. So this is Sundar and you are watching Mindful Finance. So let's see what is PE ratio. So let's start with the basics. So basically PE ratio stands for price to earnings, a quick tool to assess how much investors are paying for each rupee of earnings a company makes. So you can calculate by dividing the current market price of the stock by its earnings per share. For instance, imagine a company called Amrit Sweets, which is trading at rupees 1000 per share, and its earnings per share over the past or over the last year was rupees 50. So what is the PE ratio? 1000 divided by 50, which is 20. So this means investors are willing to pay rupees 20 for every rupees 1 of its earning. Consider two companies, Company A and Company B. So both are popular in the Indian market. Company A has a stock price of 200 and a EPS of 20. So that giving it a PE ratio of 200 by 20 is 10. Similarly, Company B on the other hand has a stock price of 200 but with an EPS of rupees 40. So making it 200 divided by 40, PE ratio is 5. So between the two company, B is looking more attractive in valuation wise because you are getting more earnings for every rupee you invest compared to Company A. So this is the fundamental principle. The lower the PE is generally the better value for your investments. So now comes the tricky part. Is it always true that lower the PE is a good option? Ponder on that part before getting the conclusion. Let's take one more example now. So now make it simple for everyone to understand. So I'm going to give an example of home so that you can easily relate on how to calculate and what the PE is really. So when it comes to investing in real estate, two major factors play a crucial role. Price you pay for the property and the income it generates. So now here is the thing, the PE for calculation become a handy tool for this one. So let's break it down with two examples. Okay, consider home A and home B. First we have home A, which is located far from the city center. So the cost of home A is assume 50 lakhs and it earns 20,000 rupees a month for in a rent. So totaling 2.4 lakhs a year. So now to find the PE ratio, so we divide the cost by the annual rent. So for home A, it is 50 lakhs divided by 2.4 lakhs, which gives us a PE ratio of 20.83. Next, let's look at home B, right in the hustle and bustle of city. So this property cost 2 crores of Indian rupee and the rents for this particular home is assume 50,000 a month. So in annual it comes around 6 lakhs. So doing the same math, the PE ratio for home B comes out of 33.33. Now you may think immediately based on the PE, which PE is low? Home A is the low PE, which means as per the explanation, lower the PE is better. So home A has a lower PE. So we will immediately conclude that home A is good because which is giving good revenue for 1 rupee. From the home investment, you have to spend 20.83. Whereas the home B, 33.33 rupees you have to spend for 1 rupee earning. So obviously you will conclude that home A is the better option here. Now consider this scenario now. So real estate is not just about static numbers. So properties grow in value and rents also can increase. So let's assume this scenario now. Home A's rent grows at 2% per year and home B's, which is in the city, increases by 6% every year. So the difference in growth rate can significantly affect your decision now. Let's check that out, how it is different. Considering the next 10 years, home A's rent will rise by 2.4 lakhs, about 2.93 lakhs. Meanwhile, home B will leap to roughly 10.74 lakhs. So this means home B could reach the break-even point very earlier than home A. So speaking of break-even, let's calculate when these homes start making money on their own. Okay, so for example, home A might take about 20 to 23 years considering 2% growth in rent. But home B, the 6% increase, it could break even in just 15 to 18 years. Why is all this important now? Understanding these metrics, PE ratio, growth rates, break even, what is this all about? These are the things helps you to make more informed decisions about which property to invest in. It shows how location and growth potential can significantly impact the profitability timeline. Similarly, if you think about any kind of a stocks, you can check TCS, Tata Motors, State Bank of India. You check all these companies and check the PE and compare it. Now each will have a different PE. Infosys may have a high PE, BHL or SAIL might have a lesser PE. So based on this, you cannot immediately jump into a conclusion that the lower PE is the better option, right? We have to think two perspectives now. One is, so we discussed about real estate, right? Similarly, each industry reacts differently, right? If you talk about like public sectors like Steel Authority of India or Hindustan Petroleum, BPCL, whatever it is, right? So think about all this stock and Reliance Industries, right? So these are the things in a similar sector, right? Which are in the energy sector. So within the sector, you have to think about which is low PE and which has a good growth potential, not just the low PE. We discussed the example, right? Not just the low PE. We need to think about how much growth the company is going to, like how the company is going to grow in next 10 years. So that is a very key point we need to look. Sometimes the BPCL or HPCL may grow in rate of 8%, which is our average FD return. If you think about Reliance, it may grow in 13% or 14%. You have to think in this way. Since this has a very good growth potential. For example, the home we bought for 2 crores because which is in a city. So we are assuming that the city may grow fast. The people may be afford to pay that much of rent. So to beat the inflation and everything, the rate may increase. The home away from the city may not grow similar to what is the one in the city. So that is how you have to compare. So the companies which are having a high growth potential, the people may be okay to spend or give more money for 1 rupee only. So that is the key crux of PE. So now you hope you understood what is PE and how to check PE and where to check the PE. So just to repeat again, 2 points you need to consider. One is PE value and growth potential, right? Lower the PE is not the immediate decision you have to make. You have to consider the growth potential of that particular company. If you assume that company is going to be having a good growth, then PE doesn't matter. But the point here is you have to consider the PE within the sector. So don't consider the PE of technology like software service sector and energy sector. These are completely two different industries. You cannot compare these two PEs. You have to compare the PE within that. That is the right way to. For example, a kid studying in 2nd standard, his mark, his grade, and the kid studying in 8th standard, his mark and other things. Now, how will you compare? Will you compare the 8th standard guy with the 2nd standard guy? No, right? Within the 8th standard, you have to compare. So that is the point you have to think about considering PE value. So hope you understood. Now you would have been getting good clarity about PE and where to use the PE. So as I keep on telling that, so PE is a good parameter to map with our mindful finance, which is don't make the decision immediately. Be relaxed, think properly, don't come to conclusion very quickly, think clearly, think mindfully, and then make the decision. Then the decision will be clear like clean water. Thank you.